Chapter 4, Gross Income Exclusions. So these are just some items, a chart at least of some items that are not considered income. So this is not necessarily an exclusion from income, but these are items that have been said do not count as income. So you have unrealized income, which obviously the policy reason behind that one should be apparent when we're talking about ability to pay. If you haven't actually realized the income, then it would be difficult to pay taxes on it, right? Self-help income, that basically just means, if you are doing, let's say, your own contracting, or you build a wing onto your house or something, and you're doing all the work yourself, they're not going to charge you on the increase in the value of your property based on work that you did yourself. Or they're not going to charge you for receiving your own services, basically. So, obviously, if someone paid you for something that you did by building part of your house, you would have to recognize that effort, that labor as income. But if you're doing it yourself, that's not considered income. So I know that sounds pretty obvious, but it has come up, and so they have clarified that. Rental value of personal use property is pretty self-explanatory, and gross sales price of property. Okay, so that doesn't mean that none of a sales price or none of the amount that you make when selling a property counts as income. It just means that the gross price does not count as income. So here's a list of some items that are specifically excluded from income based on either the Internal Revenue Code, the regulations, or that have been litigated and decided by a court that they are not considered or that they are excluded from income. So you have gifts, life insurance, welfare, and there are some exceptions to some of these, like depending on life insurance, what type it is, etc. But we'll get into some of those as we go through. Certain scholarships, certain payments for injury, certain employee benefits, certain foreign income, tax-exempt interest, double E bond interest, leasehold improvements, depending on the situation, meritorious achievement awards, again, that's going to depend on the situation, some types of divorce payments, gain from sale of your principal residence, home, Roth IRA distributions, costs or charge on delivery, Social Security benefits. Yeah, we'll touch on most of those as we go through the chapter. So, specifically, gifts and inheritance generally are not taxable to the recipient. That doesn't mean that they're not taxed or the person giving the gift is not taxed on them. There is a gift tax. So I think we'll touch on that more in depth later in the semester. But for the most part, gifts in the eyes of the recipient are not considered taxable. Prizes are not considered gifts. And what the IRS and the Internal Revenue Code and tax law have said is basically to determine what is a gift and what is a prize and what is a bonus, etc. You basically have to look at the intent of the giver of the gift or the prize or the bonus, etc. And obviously that makes a difference, because prizes, as you see in that third bullet point, are not considered gifts. They're just considered regular income. Again, same with bonuses. Life insurance proceeds, the face value of a life insurance proceed paid upon death is not taxable to the recipient. You see an exception there, and basically, there's a couple different kinds of life insurance. If we're talking about term life insurance, then basically all that is this life insurance paid upon death. So it's not like an investment instrument. But if you are talking about whole life insurance, that's kind of life insurance coupled with an an investment account, and so it earns interest. So that can cause some of the money earned on the life insurance policy to be considered income. And basically, when it comes to life insurance, other than the kind of amount payable on death, you want to look at how much you are receiving back from the policy, and it's basically considered a return of your money until you get to the face value of the policy, and then once you receive more than that, that's when it starts to be taxed. This whole concept of, once you get to the amount you've paid, so premiums paid, once you go above and beyond that, that's when things start to be taxable. So like if you own a life insurance policy and you sell that life insurance policy prior to the person who's insured on that policy dying, any amount you receive on that is not necessarily taxable, only the amount that's greater than the amounts that you paid for it. So this just, again, is kind of common sense, because it's just going back to the idea that if you buy something, you're not going to be taxed again on the amount you paid for it when you sell it. You're only going to be taxed on your increase. Okay. If you have accelerated death benefits, which is basically if you're terminally ill, then you can get an accelerated benefit that kind of helps pay for your end-of-life care. To be able to get that, the doctor must think that you're going to die within the next 2 years. But it's an accelerated death benefit is basically going to be treated as if you, and I know this sounds kind of morbid, but as if you had already died. Okay, so just because it's been accelerated to help pay for stuff before you die doesn't mean that you're going to be, or the recipient is going to be taxed just because you haven't died yet. Okay, if you're permanently disabled, you can also receive an accelerated benefit sometimes, and the tax-free payments are limited to $330. I believe that's per month in 2014. If you end up selling your policy and the amount of total premiums you paid is less than the amount that you get it for, there's no loss recognized. So even though if it had been for more than that, you would be taxed on it, less than that does not equal a loss. If you get some type of award for doing very well, meritorious achievement, generally that's going to be taxable income. The only exception is going to be for one of these type of religious, charitable, scientific, educational, artistic, literary, or civic achievement awards. So these are basically, for the good of humanity type awards, and that is only going to be considered not taxable if basically you get no benefit out of it. So if you donate all proceeds to a charity, you didn't apply for the award to begin with, it was just awarded to you based on someone else's nomination or whatever, then, and if there's no condition like, hey, you have to appear for our organization in person for the next 10 years because we gave you this award, if none of that is true, or if those parts that need to be true are, then you don't have to pay taxes on. And again, for a policy reason, this makes sense, because obviously if you didn't apply for the award, and you've not agreed to do anything to get the award, and you're not keeping any of the money, it doesn't make sense that you'd have to pay taxes on it. Most scholarships and fellowships are considered excludable, but only the portion related to qualified tuition and related expenses, and this basically covers fees and anything else that's a related expense other than room and board. Okay. So this could be for books, supplies, equipment, etc. Basically cannot cover room, board, and laundry. Section 529 plans are qualified tuition payment programs. We won't touch on those all that much, other than just you should have a basic familiarity with the fact that a 529 plan theoretically allows you to, well, they're after-tax contributions, so the money that you put in has already been taxed on, and it can build interest, and you can pull it out to pay for qualified tuition and expenses for yourself, your spouse, your dependents, and not have to pay taxes on that as long as it's covering, again, the same things we talked about for scholarships, tuition, books, fees, etc. And I believe room and board also qualifies under the qualified tuition program. Another bullet point that's important to note here is most of these exclusions and benefits and things that can help reduce your tax liability, most of them have some type of income limit to where once you surpass a certain amount of income, they kind of take away the benefit. Okay, this is one of the few that you could be, Bill Gates and still contribute to a 529 plan and use that money tax-free in the future. Again, I'm not going to get too much into the details here. You can read this slide and make note of that. Generally, payments on account of personal physical injuries or physical sickness are not considered income. This does not include what you would call a, losing the word here, punitive damages. Okay, so this is basically if you are receiving some type of payment like a lawsuit, payment for physical injury or physical sickness, it has to be basically for to compensate you for the amounts you paid to treat that physical injury or physical sickness. It's not going to be if you received money from the court because they wanted to punish the person who hurt you, and the money that you received had nothing to do with how much it cost you to treat your injury or sickness. That amount, punitive damages is what that's called, and that amount is always taxable. Just like you see there, punitive damages are always taxable, and that doesn't matter if a physical injury is involved or not. And the punitive damages in a lawsuit will always be separated so that they're labeled punitive damages in the amount of XYZ, so that you can keep track of what amount was taxable and what amount is not. Again, long-term care payments. I think I said earlier in the slideshow that the 330 limit was per month. Sorry, I had a moment there. That's actually $330 per day has been established as the amount of money that can be excluded per day. So backtracking to what we were talking about before, this is kind of if you get an accelerated death benefit that covers a permanent disability, you're limited to $330 per day. And also in this case, if you have some type of long-term care payment that you're receiving, the excludable tax amount is only $330 per day. Fringe benefits. So generally anything paid to or on behalf of an employee is includable in income. There are certain fringe benefits that have been specifically excluded. Those that have been specifically excluded can be deducted still as expenses for the employer, but the employee does not have to include those in income. So some of the more typical examples of that, the biggest example would be the employer paid insurance, or the amounts that an employer pays on behalf of its employees for insurance. You've got parking, professional license fees, training, gym memberships. The paid insurance is the only really big ticket item that is excludable as a fringe benefit. Most of those other amounts, like parking is limited to a certain amount, training, gym memberships, etc., are pretty limited there, but employer paid insurance, that could end up being, a significant percentage of your gross income that you're getting paid. So that's actually a pretty large fringe benefit that you receive without having to pay for it. And I think the policy reasons behind that are pretty obvious. You see there that one exception there for employer-provided term life insurance, anything greater than $50,000 should be included, or the value of any life insurance greater than $50,000 should be included in income. I've never seen that actually done. I've worked at many places where you get, like a year's worth of salary as life insurance, and even those people with a salary over $50,000 are not getting included in this. So I think that's one that is not necessarily followed all that closely. Although obviously, if an auditor came in and looked at that, that would be an issue. Again, just this is what's in Section 132. The points to pay attention to here, that second bullet point, an employer generally cannot discriminate and give certain benefit packages to the executives or really high-level employees, and lesser packages or benefits to lower employees. It's funny because one of the biggest offenders of this, I think, is the federal government. And if you look at the benefits that, for instance, Congress gets compared to just a generic federal employee, these benefits can be substantially different. So that's fairly ironic, but such is life. But generally, you are going to get dinged for any benefits that a highly compensated employee receives that a lesser employee or lower compensated employee doesn't receive. Doesn't mean they can't get those benefits, but those particular benefits should not be tax-free fringe benefits. Here's just some of the specifics with respect to these different types of fringe benefits. Some of the specific provisions, limiters. As you can see, because of the nature of the limitations put on these, again, like I said, they're all fairly small ticket items. Adoption expense is another exception, but again, that's phased out as income levels increase, and also not as common. There's not that great of a percentage of people that actually adopt, so it's not as big of an issue. Just some more specifics here. You can take a look at those. Obviously, these would be things that you probably wouldn't memorize. You'd just be, have at the ready for reference material. Same here and here. For meals and lodging, this one, again, is just one you should have a reference for. I would, be comfortable with the idea or the concept that it's generally not includable if furnished on employer's premises and for convenience of employer, and otherwise it would be includable in income. Just an example of a fireman, for instance. For foreign earned income, the general rule is U.S. citizens are taxed on all income, even if that is earned by a U.S. citizen working in a foreign country and received from some entity in that foreign country. Now, if you're in a foreign country and receiving money from a company in that foreign country, it's very likely that that income is going to be taxed before it gets to you. So, if that held true and you had to include all of that income in your United States tax return, then you would end up being taxed twice on that. So important to note that yes, even if you're working, if you're a United States citizen, if you earn money anywhere in the world that falls under the category of income and that we've described, the United States expects their cut and expects you to file a tax return. Okay, but they've also put this foreign earned income exclusion and also a foreign tax credit into policy so that you're not taxed twice. The reason behind this is from a policy standpoint, you do want to encourage foreign countries and entities in foreign countries to employ United States citizens, because theoretically, at least some of that revenue probably will end up, or at least some of those earnings, I should say, will probably end up back in the United States. So these are the specifics for, these next two slides are the specifics for the foreign earned income exclusion. So you can basically get a dollar for dollar reduction of liability for taxes paid versus taxes owed. So that would be the tax credit. So let's say you make $100,000 in Mexico and they tax you $20,000. The Mexican government does. You could come back on your tax return in the United States and say, okay, I paid $20,000 in taxes to Mexico. Let's figure my tax liability here, and whatever the liability ends up being on my earnings, I can reduce that by $20,000. Okay. Alternatively, I can exclude up to $99,200 of foreign earned income from gross income reported on Form 1040. So again, if I earned $100,000 in Mexico, all but 800 of those dollars would be excluded from income. And you can also include, as you see there with that calculation, some housing costs from that as well. To be able to claim this foreign earned income exclusion, either the tax credit or the exclusion, this must be true. I'm sorry, this is only for the exclusion. The tax credit you can claim no matter how long you are present in the country. As long as you end up paying taxes, you would be able to reduce your United States tax liability by the amount that you paid to the foreign government. However, if you want to use that $99,200 exclusion and exclude all that money from your income, these things must be true. You must be a bona fide resident of one or more foreign countries during the tax year, and combining all the time you were resident in one or more foreign countries for the year, you must, during that year, have spent 330 days in one of those foreign countries. So it could be 30 days in one, 150 in another, 150 in a third country. As long as your total number of days spent in a foreign country adds up to 330 during the 12-month period, then you qualify for the exclusion. Just a concept to note: when debt is discharged, generally it is considered income. Okay, so again, there's a possibility, if you're talking about family members or friends or whatnot, that the discharge of debt would be considered a gift. But if it's not considered a gift, then it's going to be considered income to the taxpayer. So generally, the general rule would be income to taxpayer. Okay, and that's covered under Section 61 of the IRC, or the Internal Revenue Code. Discharges in bankruptcy are not considered income, and if the taxpayer is insolvent at the time of discharge, then that is also not considered income. certain student loans are considered excluded from income when they are forgiven. That only holds true right now for the public service, forget the exact name of the program, public service loan repayment or something like that, where basically you work for either a nonprofit or a government agency for 10 years, making payments during those 10 years, and the balance of your student loans are forgiven after that service, and it's been documented and everything. That particular program has, in its legislation, has stated that the amount forgiven is not taxable. Now, for most federal loan programs, after a certain period of time, which I think right now for most programs is 20 years, and under the new pay-as-you-earn program, I think it's 15 years. But anyway, if you make payments on your loans for that amount of time, the balance that's left over is forgiven. But right now, as it stands, that balance forgiven is considered income. Now, I think also there's some legislation that has been pushed for in Congress, still has not passed yet, but legislation, I believe personally, will be passed in the not so distant future that would eliminate the tax liability from all student loan forgiveness programs of the federal government. We'll see. So like I said, as of right now, for most programs, unless you're in the public service loan forgiveness program, at the end when your loans are forgiven, those would be taxable. And that's the forgiveness of debt is generally considered taxable. For tax planning considerations for this chapter, again, deciding as an employer what fringe benefits to offer obviously is a tax planning consideration, because depending on what the benefits are, you as the employer could get tax deductions based on what you offer, and the employee could not have to pay tax on them. Yeah, so that's pretty much it for this chapter. Again, a lot of that stuff, the devil is in the details as far as how you use that stuff in practice, and you should just basically be familiar with the general concepts in each of the exclusion categories. You should be familiar, if you are a tax practitioner at least, or if you're going down that road, in your job you would probably want to be familiar with which exclusions had certain limitations. You may not memorize what the limitations are, the specific dollar amounts, because a lot of times those will fluctuate year to year. They may be tied to the inflation rate, or they may just be something that Congress changes based on the inflation rate every year or every number of years. But you would just want to know, hey, I know that there is this certain limitation to this exclusion, so if I'm working on something or for a client that's going to use this exclusion, I need to make sure that I look that up and find out what the exact numbers are.